Welcome back, everybody, to the Informed Home Buyer podcast. Sort of a special, timely episode today. Today was the December Fed announcement in regards to rate cuts. It literally is hot off the presses. It just happened. They started that announcement at 11:30 our time in California. And so we wanted to get on here and bring to you the results of that because the results are going to be a little counterintuitive before we get stuck into the Fed rate reduction and what that means for mortgage rates. I want to welcome Dave Miller back to the podcast. Thanks for being here, Dave.
Hey, Rich, thanks for having me.
If this is your first episode, of course, I am a realtor with 20 plus years experience. Dave's a lender with 20 plus years experience, and we're here to help you make the highest quality real estate decisions you can from the comfort of your couch. And that means interpreting some of the data and the noise that you get on the news about things like this Fed rate cut announcement. So I'll pivot to you, Dave. What did the Fed do in terms of rates today? And just as a clarification, these are the Fed's short-term lending rates. We are not right now at this moment talking long-term 30-year fixed mortgage interest rates. But what did the Fed do, Dave?
Yeah, well, good point, Rich. So what the Fed did came out today, and they lowered their short-term rates by a quarter point. So 4.25 to 4.5. And what this is this is the rate that banks and financial institutions charge overnight. So it's really the short-term interest rates. How does that affect mortgage rates? Well, let me back up. And the Fed's, this is their number one tool for combating inflation. So the goal with them lowering and raising rates is to just to monitor the state of the economy and the inflation rate. And typically, if what we know is inflation increases, they will increase rates. As the inflation gets back into check, they will lower these interest rates. So we were expecting, consensus was that we would see upwards of 4 quarter point cuts next year in 2025, possibly more than that. But the consensus after today's meeting was possibly no cuts to a cut, but they did cut a quarter point and announced that in 2025, they anticipate right now only 2 more quarter point cuts. So it wasn't what we want to necessarily hear, but
Yeah, it was a little bit of a mixed bag announcement in that they went ahead and cut the 0.25, but they didn't cut it with confidence. They weren't swinging for the fences. They sort of said this was a back and forth and this was a marginal call. We decided to do it anyway, but their language around that was, we don't see a reason to be hasty moving forward and doing more rate cuts. The signs in the economy are suggesting to us we should be conservative about further cuts. And they increased their inflation projections year over year, and they reduced their projections for how many cuts. They cut that by 50%. So from 4 cuts to 2. And even those 2 are in question based on their language. Would you agree with that?
Yeah, I would agree with that 100%. So, the next question for the folks watching this is, how does that affect mortgage interest rates, right? And affects us real time for our buyers. And I think the one thing that you and I always talk about on these podcasts for people to pay attention to is, this is stuff we pay attention to all day, every day. You're hearing it on the news. If you're in the possibility or a position where you're considering buying a home, we don't want this to sway you one way or the other. This isn't going to have, it all has impact on all of us, but it's not enough necessarily to determine or make the decision whether you should move forward and buy a home or not.
In other words, you're going to buy your home in a certain period of time, and the rate is going to be what it is, and you should be planning based on the prevailing rates at the time you're starting to think about this, not planning with an expectation of things getting significantly better. Is that your stance on that?
That is my stance on that. And the other thing is where, let's not sit around and sit on the sidelines and wait for rates to get sub 5%, because I don't see that anywhere in the near future. And when I talk near future, I'm probably talking 2 years, right? Like at least based on what's happening today. So, and the other reality is, in the 6% range of interest rates, even 7% historically, that's a really good rate. It's where we probably would average out over the long haul. So this is the norm.
Yeah, and we're going to actually dive right into and even show some charts as to what this announcement caused today. But just again, from the 30,000 foot view, if you watched last week's episode where we were preparing for this announcement and telling you what to expect, we were telling you pay more attention to the language around the rate cut than the cut itself, because whatever rate cut they do or don't do is already kind of baked into the market. Everybody's already got an idea about that. They've already projected and planned for that. So the rate cut itself doesn't actually really move markets unless they do something different than everybody's planning. If he had not cut or if he had raised, that would have moved markets. But the fact that he did what we expected him to do didn't move markets, but it was all the language around it about the fact that they are not seeing signs that they should be hasty to lower rates again, that they're reducing their projections from 4 rate cuts to 2. And they did acknowledge, and we don't do politics on this show, there's nothing political about this statement, but there is a new incoming administration that has proposed potentially broad and sweeping economic policy changes. And Powell did acknowledge that some members of the committee, not all yet, but some of them are preparing for that by baking in more uncertainty into their projections. And anytime you start throwing that word around, uncertainty, we're going to see them pump the brakes on any kind of reduction. So until the new administration takes power and starts to establish and push through some new policies, and they can see the effects of that, they don't know exactly what's going to happen. And because their dual mandate is to keep inflation down and keep a strong job market, the best thing to do is keep their powder dry and wait and see until some of those new policies are really proposed in a formal way. And they are starting to bake that into the cake. So all of the other financial metrics, had this announcement been, in April 2025, after we've sort of seen what some of the policies are going to be, the market could have responded differently. The committee could have responded differently, but there is some uncertainty with us having an administration change in Washington that they're also baking into the cake. Were you kind of feeling the same from what he was saying there?
Yeah, I 100%. And I think what they also do is they hedge themselves. And what they don't want to do is get into a position to where they got to turn around and raise interest rates. So it's easier to say we're going to slow the rate cuts, the number of rate cuts, than to cut further than we probably should have, then raise it back to a certain level. Like you said, let's pump the brakes. Let's get into, the middle of 2025 or the end of the first quarter of 2025, reevaluate. They could always come back out and say, hey, we got this in check. We're now considering increased rate cuts. That's a possibility.
Yeah.
And I think it's interesting that when the Fed's speaking and they're talking about the years 25, 26, and even into 27, where folks that are probably watching this video and us, we're paying attention to the next, 90 to 180 days. That's really our window that we're working in, because that's typically when a home buyer or someone that's considering a purchase, that's usually the window that they're working in. And that said, I don't expect major swings during that. Today's a blip, and I'll probably maybe a good time to share that chart, Rich.
Yeah. So when they come out with this negative, not even negative language, but language that indicates there is not going to be continued rate cuts or continued easing, then the mortgage market, the markets that we look at that are going to establish your mortgage interest rates, are going to respond. And if they don't think rates are coming down, they tend to panic more than they do positively react if they are coming down. And so what we expect to see when he comes out and says there's going to be 2 less rate cuts than we planned is we expect to see the mortgage-backed securities market worsening. And we expect to see interest rates rising. And this is a counterintuitive piece I said at the top of the show is, you might be seeing headlines coming across your iPhone right now saying Fed cuts rates, woohoo! But if you're a home buyer right now and you're thinking about buying a home, based on their rhetoric and what they said and their language, it's actually going to cause a worsening in the mortgage market. It's going to make interest rates go higher in the short term and then probably consolidate out to be about the same, which is all to say, like Dave said, don't expect rates to come down much, if any, in 2025. We'll talk about how you make decisions about when to buy a home after that. But Dave, we predicted, that if they said something negative, we would see a worsening in the market last week. So glad we did. We got proved right. I love it when that happens. But let's show them the chart and show them how the market responded directly after Powell's announcement.
All right, let me share this here, and I'm going to pull up the chart. Let's go. Here we go. And then I sent it your way, Rich, so you can now share the chart, and I'll kind of explain what's going on here once you're displaying the chart.
Yeah, well, there we've gone full screen for him.
Okay. All right. So if we look to the far right of the chart, that's where we're at today. If you read the numbers there, where we opened at 99.34 basis points. Again, this is the 30-year mortgage-backed security. There's different coupons. This is, which we won't get into too much today, the 5.5 coupon. And we got a close of 98.78. That's not where we closed at today. That's just where the last reporting was when I pulled this chart. So you could see there's about a 66 basis point swing from the high of the day, which before the Feds came out, we were up. I think the last I looked, before I looked at the chart, we were up 10 basis points. So we were up as much as, 22 basis points. And we see that swing. And so that big red drop is negative for interest rates. And that's probably the equivalent of, I would say 1/8% in interest rate, plus or minus. And it just depends on how quickly, secondary markets respond to the pricing. And I always mention is when the bond market drops like this, and it's got a negative impact on rates, servicers and lenders are very quick to raise interest rates, or the cost to get that interest rate, versus all these green that you see on the chart are when the bond market's improving and your mortgage interest rates improving. So I think the moral of the story is, if you had to lock in a loan today because you were closing on a house next week, bad day to do so. But don't get freaked out by this, as this is what we pay attention to all day, every day. And you see, typically we have once you get into contract, a 2-week or 3-week window to where we could float rates and lock. So no one's stuck with this today. This is just where we're at today. And we're going to see probably over the next couple of days, the market reacting to what Powell said about easing the number of rates for next year. And then next week, the week after, we're going to forget about that announcement. We'll be thinking about the next announcement, and we'll be seeing what other indicators are affecting the market moving forward.
Yeah. And so before we take this chart off the screen, Dave, just to give people an idea of the swings, looking sort of straight up from December 9th, we've got that highest green candle. What does that best green candle represent in terms of, if you were locking in right at that second, what kind of rate range would you be in there?
Again, good question, Rich. And we always talk, every consumer is a little bit different. So we're cautious to quote specific interest rates, because it's based on credit score, debt to income ratio, loan to value, number of factors, the type of loan. But just in a range, I would say that green at the peak there is a somewhere in the mid sixes interest rate. And now where we're at the far right, I would say we're in the high sixes to low sevens. So you can see, and going back all the way to October 24th, we're, basically 3 months there. We have been kind of averaging in that 99 window as an average. And so that 98, which we talked about as the close, we're hoping to get what's called a floor of support and then bounce back up. So what the market's doing is they're testing a floor, and then we'll see it bounce. So when you look at these charts, you see these long, skinny lines that are short-term low or intraday prices that maybe are breaking through what we call a floor of support and then bouncing back up.
Yeah, and a floor support is just sort of where the market is comfortable buying at, where as the prices fall, people say, "Oh, I'm happy at this point." I move in, and people move in and buy, and it bounces back up. And when you see it break one of those and drop below, then there's again the ugly word of uncertainty. So right now we're in a little zone of uncertainty, and we have to wait over the next few days to see where it finds new support, where it bounces, and then it will consolidate out. And I'm going to give my best prediction, and then Dave, who's smarter than me, will tell us if I'm right. But my best prediction here is that we're going to see, I don't know where it will bounce from. I don't know where the new floor of support will be, but over the next week, I think we'll see this thing consolidate, and we'll end up kind of back where we've been, around that 99 basis points. And I think we're going to be hovering in that range most of 2025. Is that reasonable, or am I crazy?
No, I would say that's reasonable, at least for the first quarter or the first part of 2025. And then anything that can happen to see us bounce, you
Yeah.
see that bounce in December, that we got all the way, above 100, even though that was short lived. But the idea is, as soon as we get some stability and economic data that comes out on a weekly basis, doesn't swing the market one way or the other, we typically will inch up or down. So if you look in the middle of November, you see pretty tight windows there. That's more typical, where where we see these large swings as something is happening. There's some announcement like today that's causing this red candlestick to drop way down. So I think you're right, Rich. And as soon as we start, we find a new floor, and ideally that's going to be 99 plus. And then hopefully at some point we just continue to trend up. But again, as a buyer, shouldn't get too concerned with this. We're typically, when you're in your window of time that we're going to buy or lock in an interest rate, these are things that are out of our control. And that's why when we're quoting you an interest rate, once you've made the decision that you're ready to start shopping and buy, we're going to quote you an interest rate, typically with a 0.5 point variance. So usually a 1/4 point higher if you decide to buy that home and rates get a 1/4 point worse, you're still comfortable with that. Rates can get a 1/4 point better, that's all bonus, but you have to be willing to be able to stomach those swings, and it shouldn't impact your ability to buy, or you probably shouldn't be looking for a home.
Yeah, and I mean, if you had to lock today or in the next 3 days, which it almost never happens that we have that tight of a window, then maybe this Fed announcement had a significant impact on your life. But for the most part, I feel like these Fed announcement days are sort of like a Christmas morning where each package you open is socks or underwear. You know what I mean? It's not, it's not great. I was hoping for better, but it's not horrible either. I need this, I can use this, but it's kind of it's a neutral thing. I think people expect it to have these big swings and big impacts because the media really hypes it up that way. But the truth of the matter is that we're going to be about in the 6 to 7% range, and in the mid sixes for the foreseeable future, pending, of course, we don't have a crystal ball. There is that policy uncertainty that we talked about that could have an impact. But until new policies are actually pushed through and enacted or announced in a formal way, I think this is the landscape. And I think what our industry hasn't been doing as well a job at is trying to get people to the point where they accept this is the new normal. These are the interest rates for the foreseeable future, 6 to 7% range. And you either can afford a house or you can't, because they're not changing much. They're not going too far either way.
Yeah, and I think, Rich, you bring up a really good point. And as soon as this, I think we're seeing this more in the marketplace, and consumers are understanding that, maybe somewhere in the 6s is the new norm. The further we get away from those, I don't even know if I want to say it out loud, the interest rates that were during the pandemic, where we might be even double of what those rates were. That was just an anomaly. And so this again is kind of where historically we're still below or equal to what mortgage rates typically average. So this is where we're at, and we kind of need to accept that and work within these windows. And if we get incrementally better, it's great. If we get incrementally worse, unfortunate for a home buyer, but again, that's the market we're dealing with.
Yeah. So I think if you're sitting there right now and you're thinking about buying a house now, or thinking about, do I buy a house now? Do I buy a house in 2025? Do I buy a house in 2026? I think interest rates are no longer a very viable way to make that decision. They are what they are. Run your projections kind of down the middle at a 6.5% rate, and you should be within a 0.5 point of that either way. If that math makes sense, then you need to look to other decision-making factors, like, does it work for your life? Is it a good hedge against inflation in your town? Are rents going up? Do you, in particular, have some life changes where you need to lock in some of your monthly, budget line items to help yourself? And compare this against the likelihood of the house prices going up. The part of the subtext of what Powell was saying today is we keep trying to break the American economy, and it's not breaking. We're not effectively breaking it well enough. It is shockingly booming right now. It is doing really, really well right now. He even said at one point, and I encourage you all, go, if you are this kind of geek like us and you like listening to stuff, go listen to it. He said at one point, when I go to these international meetings around the world, this is not the norm. We are a standout case right now in terms of having the strongest economy in the world. And so to that end, right now, the predictions for housing are for it to continue to be strong and to be increasing, to be seeing appreciation year over year in the 3 to 5% range across the nation over the next 5 years. And you're going to lose a lot more in purchase power due to that home increase than you will due to the tight range of swing that we're going to see in interest rates, at least over definitely through Q1 of next year. But if I had to guess and do a little more crystal ball work, short of any really wacky policy moves, probably through the rest of next year.
Yeah, I agree with that, Rich. And I think for the audience that's watching this, and you can holds true whether you're a first-time home buyer, possibly a move-up borrower or buyer that's sitting on one of those low interest rates that you just don't want to let go of, and you're hoping it's going to come back. We could talk through ways to maybe keep that rate or keep that home and still buy up, but or it's that move up buyer, or again, the first time home buyer, or an investor, someone that wants to get into wants to buy an investment property. So if you think you're in any of those categories, don't know that trying to time the market and predict for rates to get back below 5 is something that we're going to see.
No, but keep watching. One of our next podcasts coming up will be us talking about ways to retain those amazing rates from the pandemic era, leverage those rates to increase your personal wealth and make some real estate moves without having to let go of that rate or all of that rate. So we've got some good techniques for you coming up in terms of that. If you are one of our people who are feeling that lock-in effect, you've got that 3.25, or even better rate that you're sitting on. You don't want to let go of it, but you do need or want to make a move. We've got some ideas for you to help you with that. That'll be coming up on a future episode. But for this one, I think we'll wrap it up here. The 30,000 foot view is as we approach the next Fed announcement, we will already have an idea of what they're going to do that'll be baked into the cake. So don't look at what they do. If what they do lines up with what everybody says they're going to do, look at what they say. If the rhetoric is still, we probably aren't going to reduce at the next one, or we're going to continue to be cautious about reductions, then we're going to see a flat to worsening mortgage market for you. And if they say, hey, we actually broke things like we wanted to, and so things are getting worse, which actually means better for interest rates, and we're going to do another drop, and they project that out, then you're going to see things get a little bit better. So you can start to get a sense at home. You can read through the noise on the news, watch what Powell actually says when he makes his little announcements, and you can get a sense even for yourself about what is going to happen. But for now, what we're telling you is interest rates are a little bit worse on the day and probably going to be about the same through Q1 of next year. I hope that helps you with your decision making. I hope it takes one variable off the table as you approach home ownership. If you have any questions, reach out to Dave and I via direct message here on YouTube, or ask questions down in the comments. We'll address them on the next show. As always, thank you for watching. Thank you for making it to the end with us. And thank you for being committed to your own financial education. Dave, as always, invaluable insights today. Thanks for being here with me.
Thanks for having me, Rich.
All right. See you next time, everyone.